Hi, everyone, and welcome to this year's China and the World Summit under Equal Ocean's World Innovators Meet. I'm really happy everyone could join us today. I'm AJ Cortese, head of Equal Ocean's New York office, and I'm here to shed some light about today's agenda. But first, I'm going to take this opportunity to introduce a little bit about our company, Equal Ocean. So, we are an investment research company and information provider based in China and the United States with the main focus on TMT and consumer internet sectors. So we aim to serve our global clients in the Chinese market, keeping tabs on a wide range of issues from key companies, business trends, and strategies, and while also assisting Chinese companies with their global expansion and providing essential insights into these foreign markets. And so, in addition to this core business, we try and build and scale a platform that allows different stakeholders, including international investors, corporations, startups, and people in the technology industry, to communicate with each other, to share knowledge and experiences, to overall foster greater global innovation. So, the World Innovators Meet, or WIM as we call it, is an annual flagship event that really started in Beijing and Shanghai. Last year, we had nearly over 100 speakers from 23 countries and around 300,000 people joining our sessions. And so this year, WIM includes 9 different thematic forums in Shanghai, as well as an investment focused event in New York for the first time, along with these 2 online sessions of China and the world. So today's topic, just to shed some light, is about investing in China. And this year, we'll host our first branch of WIM in New York as well to discuss some of the hottest topics on international investors' minds when it comes to investing in China. So foreign investors continue to play a major role in investing in Chinese technology and consumer internet more broadly. But China's economy is undergoing some profound shifts towards a tech-driven investment-led economy that is starting to replace some of the export-led growth and property development that we've seen over the past decades. So this focus on core technologies and innovation really allows an opportunity for our company to try and connect like-minded individuals and innovators from all over the world to really discuss the latest trends in the Chinese market and to try and foster a better understanding between global investors and the Chinese market. So I'm delighted that our discussions today will hear from a range of experts on these topics who will cover investing in China and what the next era of investment in China will look like, along with much, much more. So I just want to thank everyone again for joining this year's edition of WIM, and welcome to the first day, Investing in China. And we hope you're able to glean some insights from our range of speakers today. So thank you again for your time, and really hope that you enjoy the event.
Great. Hi, hello everyone. Welcome to the World Innovators Meet. My name is Rory Green. I'm head of China and Asia research at TS Lombard, the investment strategy and economic research firm, largely based in London. Today, Ecolotion have given me the quite tricky task of deciphering China's regulatory crackdown all within 15 minutes. So in attempting this somewhat difficult exercise over the next quarter of an hour, I will provide, I think, some clear investment conclusions, sectors to bet on, those to avoid, and I hope surprise you with some of the hidden winners from the regulatory crackdown. But first, let's set the crackdown in a wider context. And that wider context is, of course, the Common Prosperity Shift, this new framework for economic and regulatory management in China. And this is a profound change that is increasingly better defined. We've had essays, policy statements from leading figures, the historical resolution of the 6th plenum, but it is still quite nebulous concept. From our interpretation, the big sort of macro takeaway from this change in management, economic and regulatory, is a focus on slower, more sustainable, and very importantly here, more equal growth. And this GDP chart gives you a rough growth path over the next, say, 14 years under the Common Prosperity Framework for growth. And this is based on implied GDP targets from the government. So to define this new framework better and to tie it into the regulatory crackdown, let's go to the source, the 14th five-year plan from the government. There are Common Prosperity Development Zones, but to focus on the country level, the five-year plan is best. And what we can see here straight away is that the biggest chunk of the targets are for welfare, for social well-being, for boosting disposable income, to improving the education system, improving welfare. The second largest chunk, the environment, reducing energy consumption, cleaner energy, greener energy. And then innovation, this is mainly a technology hardware. Advanced manufacturing is viewed as the future of future Chinese growth driver. And then finally, security and of course, economic development. So national security as well. So that is welfare, technology, clean energy, national security. All very positive, quite laudable goals, not the arbitrary moves and targets you read about in Western newspapers. If we take one of these as an example, we look at the Gini wealth coefficient for China, a big spike up in the last 20 years, which is quite normal as a country develops rapidly. You can see India had a similar jump. But bringing this wealth coefficient, that's included income and asset inequality, is an important and laudable goal. What does this mean for the regulatory crackdown? If we look at the current moves since November last year with this framework in mind, we can see that pretty much all of these key major crackdowns have had a common prosperity goal at the center. We take Ant Financial. This is a sustainable growth goal, controlling financial risk. Ant was about 5 to maybe 6 times more leveraged than a typical Chinese bank, and certainly indeed a need of greater capital requirements, greater regulation. We look at the platform tech groups, the internet monopoly firms. This is about better conditions for gig workers, more bargaining power for SMEs, protection for smaller rivals. And if we look at Didi, it's been in the news most recently, very topical. This is about the national security element that I highlighted. Without data security, there is no national security. And this is really why we have the delisting now and the prospective relisting in Hong Kong. This is not so much, I think, a VIE question for Didi. The relisting in Hong Kong, I think, will be under the variable interest entity structure. It is more about the extra leverage and regulatory scrutiny that the US has over Chinese firms via the Holding Foreign Companies Accountable Act if they are listed in the US. So the VIE perhaps not ending, at least for Hong Kong anyway. And then real estate, we'll get onto this a bit later, but is basically blocking every common prosperity goal. So, quite rational goals, not arbitrary by any means. However, there has been a regulatory free-for-all, without question. You can see from this chart here, we've had multiple different regulators, different agencies, the markets monopoly regulator, the information and IT, the cyberspace, the Securities Commission, press, all have been regulating and cracking down pretty hard. And I think the reason for this regulatory free-for-all is twofold. The first is that achieving common prosperity targets is much easier via regulation of large companies than it is to conduct structural reform, such as the hukou reform or a property tax reform. It's much, much easier to tell Meituan to pay its delivery drivers more than it is to change the hukou system. That's one factor. The second factor is an element of catch-up. Regulators have talked about the past 10 or 20 years in China tech as a period of barbaric growth. This is unregulated, unfettered expansion into all areas with very little safeguards and control. And so part of this regulatory free-for-all has been a catch-up from a period of very lax regulation. Is it over? Are we coming to the end? Probably not. I think the catch-up phase is behind us. There is a baseline that has been set here. And there are growing signs that top regulatory authorities and leaders are satisfied. The phrase curbing the expansion of disorderly capital was omitted from the Politburo statement released earlier this week. So that's potentially a significant sign that the peak of this regulatory crackdown is coming to an end. However, regulation for some firms is now a permanent feature of the economic landscape. That is particularly the case for the critical information infrastructure providers. These are companies that are such an integral part of everyday life in China or in other countries in many cases, that the government is treating them as a utility or an infrastructure provider and is regulating them in accordance with this increased economic importance within China. So take WeChat, for instance. Imagine if this suddenly broke. This is the operating system that much of daily life in China runs upon. What happens if that breaks? So this is an infrastructure, and the regulation and scrutiny of these firms is going to persist. That does not necessarily entail infrastructure or utility valuations for the companies. I hope not. If so, it means we've got a long way down in terms of their share prices. So not a utility valuation for the firms, but a utility regulatory aspect of how they're going to be managed by the state. And actually, I think we'll see this more and more, not just in China, but in developed markets in US, Europe, regulating the likes of Facebook, Amazon, Google, who are equally important infrastructure providers there. Okay, so I've set out now the crackdown. It's linked to Common Prosperity Framework and how that is really important in driving the focus of these regulatory probes. I'm now going to take a pause and ask you to comment in the chat or have a think to yourself, who is the biggest winner of the regulatory crackdown? So I'll just give you a moment. Who is the winner? Who's benefited most from this crackdown? Feel free to write it in the chat. In my opinion, the biggest winner of the crackdown is the gig economy worker, the Meituan, Ele.me, the delivery drivers, the Didi drivers. I think they are the biggest winner of the crackdown. Why is that the case? There are about 100 to 200 million flexible workers in China. The State Council classifies around 125 million gig economy workers, give or take the description. Almost all of them have had a pay rise in the past year. The healthcare and welfare coverage has expanded, and their working conditions have improved. And this is largely because these big platforms like Meituan have been forced to pay them more, to change their algorithms to make it easier to meet their delivery targets, and to provide some sort of healthcare, unemployment insurance type of benefits. You can't really see this in the macro data, but you read the company results for Meituan, Taobao, Alibaba, etc., and others, and you can see that their profits have come down because they've had to pay these guys more. And the biggest winners of the crackdown. This is important because a lot of the analysis positing a big rebound in the monopoly internet firms stocks next year is on the premise that the crackdown has been really negative for China's economy, and because growth is slowing, then they will have to relax the crackdown. So an economic driver to stop the regulatory moves. I think the crackdown has at least been net neutral, maybe even positive, because of the boost to these gig economy workers, and that the economic slowdown will not push will not cause a pause in regulatory crackdown. That's not to say that there are other factors causing a pause. I think the baseline rules have been set or are nearly set, and there will be a tapering off of the regulatory crackdown, but it is not due to an economic push factor. So these are the biggest winners. What about some of the others in equity markets? I characterize the equity market winners as lean, green tech machines. So the lean side comes from small caps, from SMEs, who've got a much better deal, who are able to compete more fairly with the larger monopoly firms. Green is clearly green economy equities that have done very well with a huge policy tailwind and clearly a secular shift globally, thanks to the move towards a carbon neutral objective. And tech. This is tech hardware, not internet monopoly, not Didi, the taxi company, not Alibaba, the online shop. This is proper tech like semiconductors, like automation, electric vehicles, batteries. And you can see here that they have significantly outperformed the market, and the MSCI China index, which is largely weighted towards big internet companies. So these are the main winners. What about the losers? If we take aside the obvious losers, which I think we all know, which has been Alibaba and some of the other internet firms, property is a big one. It's not a tech company, but it is part of the regulatory crackdown and is going to be a loser for the foreseeable future. I think cyclically, actually, you've seen the news that Evergrande has defaulted today. I think we're cyclically at the worst in funding conditions has passed for the property sector, but in the long term, structurally, property sector is a massive block for the common prosperity goals. So if you think about investing in property, we always talk about location, location, location. I think common prosperity, you can think about property, property, property. It's a cause of inequality, carbon emissions, inefficient allocation of capital, sucking money away from more productive parts of the economy. So it's a massive block on China's long-term development objectives and will be under severe pressure for some time. That's cyclically, though, I think we're coming to a bit of a bottom, at least in terms of the funding conditions for the sector. So property, the big loser, along with Baba, Tencent, etc. So now I want to come back to the hidden winners and come back to these guys, the delivery workers, the gig economy workers who have got higher salaries and are spending more. So we're looking at the second order impact of the crackdown of some of this shift in common prosperity. It's higher incomes for middle and lower income households. What are they going to spend the money on? Which parts of the economy will this funnel to? The second order impact of these higher salaries and spending. If it was in the UK, higher salaries for delivery drivers would probably mean more spending on beer and cigarettes. In China, maybe slightly different. We're looking at apps and games, a bit more domestic travel, this kind of area. The other second order impact is the big investment into the tech hardware firms, the reallocation of capital there. And this is very important because I think at least for 5G, it gives China a pretty powerful head start versus the rest of the world. And this is very important. If we look at the early internet until now, it's been American. The first computers, the first servers, first email addresses, personal computers, mobile internet. At every stage, the US has been first and the largest market. Now, China is betting massively on 5G. It's got by more 5G base centers than the rest of the world combined. By 2025, it will have 80% of the world's 5G connections. And this will give China a head start in the next generation of telecommunications and the companies and apps that enables. So the Google was the first or the best search engine. Uber, first winner in sort of handheld mobile internet. Chinese companies likely to at least have a nice advantage in the 5G economy. So that's basically it from my presentation. I'll just do a quick wrap up now and hopefully have time for some questions. To conclude, the crackdown is part of a common prosperity shift. It contains many positive goals, but it is undoubtedly bad for billionaires and these large internet monopoly firms. Regulation, particularly for the critical information infrastructure providers, is here to stay. However, it is good for tech hardware, smaller firms, gig economy workers, and some of the hidden winners from there are likely to span out from the second order effects of more infrastructure spend, new infrastructure spending, and on where these gig economy workers, the middle class, is going to spend this increase in income. So I'll stop sharing now. Any questions if we have time? I can see one here on will other countries follow up with their own crackdown on tech? And I think certainly there will be a greater regulation of these important information infrastructure providers that I touched upon. You can see this moving very slowly in developed markets. It's a less rapid political system than it is in China, so it takes time for these ideas to filter through. But I think that will certainly feed through in the next five years or so. Let's see if we've got other questions in the chat. One question on which industry is next to be targeted. One area that has escaped attention is healthcare. The talk of the three mountains blocking an increase in China's birth rate, the demographic hurdle that China is seeking to overcome. And one of those mountains is healthcare. The other is education and the cost of housing. So property has been cracked down, education cracked down, healthcare not yet. And the main reason is it's very difficult to crack down on the healthcare sector in the middle of a pandemic. So I think once the pandemic's over, we'll start to see more regulatory push into private health in China.
Of today's discussion is so important. My name is Diana Choyleva. I'm Chief Economist at Enodo Economics, which is a macroeconomic and political research company focused on China and its global impact. In essence, we do all things China. And I tend to joke that, well, actually, it's not a joke, it's the truth. As a child, I wanted to be a detective. But in the event, I became an economist. And being an economist is kind of quite like being a detective. You have to get as many pieces of raw information. These are your pieces of your puzzle. You have to know what they are. And then you're trying to put them together in a coherent picture. And that's how we at Enodo Economics do the analysis on China. We're looking at absolutely everything in order to be able to get the story right. And up until recently, China kept its financial market largely closed for foreign investors. But this has changed dramatically. So for those of you out there who used to say a few years back, oh, well, we don't invest in China, so we don't want to think about China. Well, I have the following sort of words for you in terms of paraphrasing Trotsky and saying you may not be interested in China, but China is interested in you. Even during the last 2 decades, since China joined the World Trade Organization and before it threw the doors of its financial sector open, Chinese economic political developments shaped how the global economy and markets were developing. So China has been impacting the investor universe for a long time now. The difference going forward is that China has opened up its financial sector to an unprecedented degree. Actually, something that Western policymakers have been advising and pushing for China to do for some time, but China chose to do this now. So what I would like to talk to you today about is to take you through why China chose to do this now, and then how its financial markets are, what needs to happen for foreign investors to be comfortable investing in China, and then wrap it up with discussing how China plans to decrease its dependence on the US dollar-led global financial order. Now, if we move to the first slide, I just want to show you our strapline, which is understand China's impact on your world. Very much trying to put forward the idea that there is no way anyone in the world can ignore China. It's not just in the investment space and in the financial space. It is impossible not to think about your own business without having to have some consideration as to how China's development is going to impact you. And what has been very interesting is that often I meet with people who say, we don't understand China. We don't understand how they operate, how they think. And this message comes from very senior people, people who would not dream in the West of saying, oh, I don't understand the US economy. They would never be able to feel that they could say that. And so that has also led us at Enodo Economics to develop a series of online training, really to help, if I could have the next slide, please, to help people who are trying to understand China and how it impacts their world, kind of get up to speed. A lot of people are looking at China now because they've realized how important it is, but they're coming in the middle of the book and they're missing the context and the background. And in financial markets in particular, it's quite extraordinary. I do typically a little poll asking which body in China determines its interest rate and exchange rate policy, its monetary policy. And you'd be surprised, but the majority of people get this question continuously wrong. So hopefully, if you're interested in that field, you'd be willing to take a look at what we've done there. But now, if we move on to the next slide, let's kick off with the main body of today's discussion. Why, what has happened to China in the last 40 years of opening up? It industrialized at a breakneck speed, but it chose to keep its financial sector largely sheltered in that time. And the reason for that was that the authorities were focusing on the fast catch-up growth, but they didn't develop the financial markets because they were constantly worried that the weakness in both their banking sector and in capital markets would be a huge disadvantage and will not allow China to achieve the industrial transformation that it has. But now China has become the global manufacturing powerhouse, and it's rising up the value-added chain fast. China surprised itself, as well as Westerners, with its fast technological development. So going forward, the time has come for China to really develop its financial system in order to enable the efficient distribution of domestic savings, as well as to become more of an international center of recycling, let's say, Asian savings, if not the world's savings. So this is the reason why the Chinese authorities are at this point in time opening up their financial markets. Another, what happened during the previous period was that they were outsourcing their initial public offerings, IPOs abroad, if you'd like, listing China's most successful, biggest companies at or on foreign exchanges, to which the Chinese households had no access in terms of putting their investments or putting their wealth. And that created a lot of problems in the way wealth was distributed in China. For example, the majority of household wealth is in housing in China. And when it comes to financial wealth, the majority is in interest-bearing deposits. The equity market in China is treated more like a casino. It's a very short-termist, there is a short-termist attitude towards investing in Chinese equities domestically, and the market is dominated by retail investors. So now that Xi Jinping's guiding principle in terms of economic development is to create common prosperity, the time has come to develop China's capital markets, both in terms of bringing more of the initial public offerings at home, so Chinese households can access and invest and put their wealth in terms of preserving it long-term and increasing it into those companies, but also to shift away from housing as being the main store of wealth for Chinese households. We've heard the mantra that houses are not for speculation, they're for living in, and that has been something that the authorities have insisted on for at least 3 or 4 years. But really, with the changes that we've seen in the real estate sector over the course of this year, finally the penny has dropped. So part of China's development of its financial sector is to also provide long-term viable options for storing and growing household wealth that are outside of the housing sector and tap into the most successful parts of China's, or the most successful of China's companies. There is another reason why China is opening up its financial sector now as well, and that is that up until this point, China has used its banks as an ATM. And as you see on that first slide, bank assets are way bigger than, let's say, equity market capitalization. The banking sector has been the bulk of China's financial system up until now. But for a variety of reasons, bank lending, or some of it, has been directed to unproductive, wasteful projects. And China has built a substantial amount of bad loans that need to be worked through. So part of the financial sector opening up is also a way of using foreign finance to help China clean up its bad debt mess in its financial sector. Now, if we were not also looking at this difficult adjustment over the next few years, I would have been saying that the structural transformation that China's capital markets are going to experience over the next few years finally suggests that now is the time to invest in Chinese equities markets. In the past, if you look at the performance of the equity market in China, it had no correlation with economic growth. But because now China is starting to develop and professionalize this sector, it would have been, all other things being equal, finally the right time to put your money in Chinese equities, sit back and wait for this structural long-term adjustment to bear fruit. Unfortunately, the situation is not as simple as that at all. First of all, we have, on the one hand, the huge de-risking and deleveraging that China needs to go through. It's a very difficult process that has lowered its growth rate. The authorities at the moment are determined to push ahead with it, and the jury is out on how successful they will be. But this is an uncharted territory that China has entered, and it's difficult to say with confidence that the structural positive side of the story will overwhelm what is an extremely difficult deleveraging and de-risking process. Unfortunately, on that side of things, there is also another complication, which is that the world is bifurcating in two spheres of influence. We call this the great decoupling. We've been discussing this theme for the past 3 years. And essentially, we are observing the all-out geopolitical and all-encompassing, actually, power contest between the existing hegemon, America, and the aspiring one, China. And what that means is that not only are the economic spheres, but quite likely the financial spheres are going to bifurcate. And so it's whether you'll be able to take advantage of China's, of investing in China's equity market or bond market as a foreign investor very much depends on which part of the world you are from. China would like to create its own sphere of geopolitical influence, and certainly Asia would be part of that sphere. Of course, that is not the case for Japan, and it's not the case for India. So these are two very big Asian markets that are unlikely to fall into China's geopolitical sphere of influence. But the rest of Asia, it's probably up for grabs. And actually, if we go to the very last slide, so we're skipping a few, this one shows you that the annual flow of savings in China and Hong Kong is more or less on par with the annual flow of savings in the Five Eyes plus Japan, the Five Eyes being US alliance, US, UK, Canada, Australia, and New Zealand. So if we separate those as the sort of determined blocks, then we see that Asia, excluding Japan and excluding India, is about 1/3 of the annual flow of savings in those two areas. So the battle between the Chinese and the American financial spheres of influence will be over these Asian savings, and actually over probably German savings, but we can leave that story to the side for now. So what's important to realize here is that if you are an American fund manager, you're facing much more different constraints in investing in China than if you are a fund manager based or an investor based, for example, in Thailand. Nearly time to wrap it up. I think it's important to say before I wrap it up that number one, actually, when you look at the Chinese equity market, in terms of sort of all the nuts and bolts of how it works, it does work well. And then the issue is to decide whether now it's the time to invest in it and how to take advantage of this future transformation if you, as I said, are in the right part of the world as an investor looking at China. The Chinese bond market is a different story because whereas the equity market is liquid and very short-termist, as I said, the bond market, in particular the treasury market, is highly illiquid. And that needs to change for foreign investors to be able to invest in that market more confidently. But the policy bank bond market, of course, is more liquid, and there are opportunities there, given where China is in this adjustment phase. Unfortunately, the corporate bond market is where all this deleveraging and de-risking will play out. If you are investing in that market, you have to be prepared to have a strong stomach and take the rough with the smooth. But whatever your inclination of whether you can make money or not in China's financial markets, one thing you cannot do is ignore them. Thank you very much.
Hi, my name is Phillip. I'm the head of investment solutions at Rayliant Global Advisors. Rayliant is an asset manager that specializes in emerging markets, but we've got a particular focus on China. And so we spend a lot of our time advising clients and conducting research and building portfolios to access Chinese financial markets. And I could spend hours talking about the detailed strategies that we employ in China and how we build portfolios. But in 20 minutes, I think the best use of time is really to cover what I think are some of the most critical questions when investors are considering an allocation to China. And the first of those questions is, how do we access China? Because it turns out there are many ways to do that. If we want to invest in Chinese stocks, we can invest in onshore listings or offshore listings. And that choice has implications for performance, along with a bunch of other characteristics of an investor's portfolio. So that's an important question. And then once you've chosen a means of access to China, the next question is, do you want to apply passive strategies and simply buy the entire market? Or are there specific arguments for pursuing active management in China? And I'll briefly cover the rationale behind that decision. And then a third question that I think is important to answer, once you've decided whether to go onshore or offshore, once you've decided to pursue active versus passive management, the next question is, what should the nature of that strategy be? Should we apply the same strategies that we use in other markets to China? Or should we take an approach that's more tailored to unique features of China's market? And in addition to being the head of investment solutions at Rayliant, I'm also a portfolio manager on an ETF that Rayliant launched at the end of last year, the Rayliant Quantamental China Equity ETF. It's the first active ETF that trades onshore Chinese stocks, and half of our research team is in China. So you can imagine where I'm going with the answers to these questions. But let's start with the first one. So the first question is, how do we access China? And as I mentioned, there are many ways of doing that. China's equity market is notoriously segmented in the sense that Chinese companies choose to list in venues all over the world. So it's certainly possible to invest in onshore stocks. And historically, that was going to be on the Shenzhen exchange or the exchange in Shanghai. And now there's a third exchange in Beijing. And these are the three mainland exchanges. All of the stocks listed here, stocks that we collectively refer to as A shares, those would be considered onshore Chinese equities. But then there are also a lot of Chinese stocks listed offshore. So in the US, there are ADRs, and they've been in the news a lot recently. In Hong Kong, there are H shares, red chips, and P chips, all kinds of Chinese companies that have chosen to list in Hong Kong or in the US. There are also some listings in Singapore. I'll group those together and collectively refer to those as offshore Chinese stocks. And so a question that investors have to answer when they decide to allocate to China is, do they go onshore or offshore? Now, a lot of investors think that if they make an allocation to a global emerging markets portfolio, that they're automatically getting the right kind of China exposure. And it's absolutely true that if you invest in something like the MSCI EM index, if you invest in a fund that tracks that benchmark, you're going to get a lot of China exposure. About 40% of the index is actually invested in Chinese companies. But then when you start decomposing what actually constitutes that China exposure, what you find is that only about 5% of that 40% is actually China A shares. The rest is those offshore listings that I just talked about. Now, in terms of economic size, when you look at China's equity market, which is the second largest in the world behind the US, it makes up a little over 10% of global equity market cap at present. You start to think about, well, how underrepresented is China A in a typical investor's portfolio if we just saw that only about 5% of the 40% of China in EM is actually in the A shares. It turns out if you look at a broader global portfolio, and here I'm taking MSCI All Country World Index, that's sort of a representative portfolio of a global equity investor. Although China makes up about 10% of global equity market cap, it only has about 0.5% weight in this global benchmark. And just to put that in perspective, A shares make up 0.5% of MSCI equity. Apple, the company, makes up about 3.5% of that index. So Apple, which derives a lot of its revenues from iPhone sales in China, has about 7 times as much weight as all of the China A shares combined in MSCI equity. So it seems like from an economic perspective, just thinking about the size of China's economy, that investors should have more than they do now allocated to A shares. The second topic I want to talk about when we're thinking onshore versus offshore, and when we're thinking about China in the context of emerging markets, is growth. And of course, growth is one of the reasons that investors decide to pursue an allocation to EM in the first place. Investors reason that emerging markets, because they're economies that are developing rapidly, that there's a lot of growth, much more than you'd see in developed markets, and that if you invest in emerging markets equities, you can capture that growth in your portfolio. And there's a lot of sensibility to that type of argument. And certainly when we look at emerging markets, we do see rapid growth. On the far right of the chart that I've got up now, if you look at the dark bar, this is emerging markets ex-China. So we've taken China out, and you can see that excluding China, EM grew at about 3.7% per year in terms of GDP growth over the last 15 years. Compare that to the US, where GDP growth was just under 2% per annum over that period. So emerging markets were growing fast. It turns out China within emerging markets was growing much faster than the others. So China grew GDP at almost 9% per annum over that period. So there's a lot more growth in emerging markets, and there's even more growth in China. But then the question for equity investors is, does that economic growth really matter? Is that going to translate into portfolio returns? And for equity investors, it's not so much the GDP growth that's important. Of course, that's important, but what really matters is how much of that shows up in the earnings of companies that are listed on exchanges. And so we can look at corporate earnings growth. And what we find there is for EMX China, although these economies were growing really quickly, not all of that growth made it to equity investors. EPS only grew at about 1.7% per year over that period. Look at China, where we had about 9% GDP growth. What we see is that Chinese companies were really successful, the publicly listed companies, in capturing that growth. They grew earnings at 14% per annum over that period. So China in this respect is much more like the US. The US had just under 2% GDP growth, but managed to turn that into 5% corporate earnings growth. And there are many reasons for this. But I think looking at China versus the rest of the EM, one of the principal things to consider is that although China is an emerging market, it's got a really well-developed financial infrastructure. So just like the US, China is excellent at nurturing companies through private equity, through venture capital, to the point that they get big enough to list on a stock exchange and pass off the benefits of economic growth to shareholders in public equities. In the rest of EM, although these economies are growing really quickly, often companies don't reach that critical mass where they can list and translate that growth into equity returns. And so when it comes to growth, China is much better than the rest of EM at bringing that growth to shareholders. Now, in the onshore-offshore question, it turns out offshore stocks, so these are the A shares that we're looking at now, offshore stocks were growing fast, but not quite as fast. So they grew earnings at about 8.5% per annum. So most of the benefits when we're talking about growth within EM come from China, and most of the growth in China is actually coming from the onshore listings. So this is one reason you might pursue A shares as opposed to the offshore stocks. The second consideration that investors often have in mind when they decide to allocate to EM is diversification. And here the logic is that emerging markets don't respond to all of the same factors or shocks that developed market stocks do. So if you add EM to a global portfolio, you're going to get some diversification benefit. EM is not correlated. It's not perfectly correlated with developed markets. So it turns out, again, you have to decompose emerging markets. And here again, we're going to look at EM ex China versus different China exposures. And one of the things that we find is that when we strip China out of emerging markets, if you look at the correlation between US stocks and EM ex China equities, you find that it's 0.77. That's actually quite high. To put that number into perspective, the correlation between US and developed ex-US is 0.89. So you're getting a little bit of diversification with EM ex China, but not as much as I think many investors believe that they're achieving. Now we could look at China, and we'll start with offshore China. Offshore Chinese stocks listed in New York or in Hong Kong have a correlation with US stocks of 0.63 over the last 15 years. So again, it's reasonably low correlation, at least lower than developed markets with one another. It's lower than EM ex China with the US, but 0.63 is still relatively high in terms of only producing modest benefits to diversification. If we look at onshore China, we find a much lower correlation. So US equities have 0.39 correlation with onshore China. It's about half what we saw for EM ex China with the US. So most of the diversification benefits of emerging markets, just like with growth, most of those benefits come from China. And within China, the balance of those benefits is actually coming from onshore stocks. And so with diversification, with growth, there's a strong argument here for choosing A shares as opposed to the offshore listings when you're building a portfolio, in the sense that it's capturing more growth and it's a better complement to what most global investors have in their existing equity allocation. Interesting fact about these correlations, when you look at offshore China versus onshore China, the correlation is 0.62. So offshore Chinese stocks have about as much similarity in terms of performance with the US as they have with their onshore counterparts. But I mentioned that I manage an active equity fund that invests in A shares. For me, when it comes to the investment opportunity in China, one of the most interesting aspects, and this is certainly where we devote most of our research energy, is trying to outperform, coming up with strategies that can beat the market. And one of the principal drivers of alpha opportunity, I would argue, is investor behavior. When investors make mistakes, it creates mispricings, and that's how active managers can get an advantage and deliver superior performance. And in China, an interesting feature of the onshore market is that it's dominated by amateur individual investors. About 85% of trading is actually accounted for by retail investor participation. And this creates an opportunity. If you think that those amateur investors are trading in such a way as to create mispricings, it creates an opportunity for active managers. Now, China is not alone in terms of having high levels of retail participation. This is a phenomenon that we see across emerging markets. China is an outlier. China has 80 to 90% retail participation. When you look at volume in Taiwan or South Korea, these are emerging markets that have been around for a bit longer. They opened up to foreign institutional investors in the 90s. And so they're now at about 50 to 60% retail, but still a very high level. And so within emerging markets, where you see high levels of retail participation, the argument is there's a greater justification for active management. There's a greater rationale for devoting research effort and resources to active stock picking, because if there's more mispricing, there's more opportunity. Is that really the case? Rayliant is a quantitative asset manager. So here we have a little bit of an advantage in terms of researching different strategies applied to different markets. We can simulate strategies in different markets and we can evaluate the performance. So one of the things that we've done is we've applied simple quant strategies. We've taken simple factors like value or momentum or portfolios that tilt to companies with higher quality. And we've applied those strategies in different emerging markets and also some developed markets. And we've evaluated the results. And one of the things that we find consistent with this argument that where you see more retail investors, you see more mispricing, it is indeed the case that markets with higher retail trading tend to create more alpha with these simple quantitative approaches. And so there's a good rationale, again, for choosing the A shares, for going onshore, because there's more retail trading there. You're more likely to trade against an amateur individual investor than you are an institution. That's not really true of the offshore listings in New York and Hong Kong. But again, thinking back to these three questions, not only do we advocate onshore investing, but we also think active is the way to go in these highly inefficient markets with very high levels of retail stock trading. There's another reason to go active in China, and this relates to risk. And this is, again, not unique to China, but when you look at emerging markets, there are lots of risks that don't show up, or at least a lot less prominent in developed markets. One of those risks in China is the risk of investing in state-owned companies. And SOEs are impossible to avoid in China. They make up about half of the market cap of onshore equity benchmarks. And one of the things we find about state-owned companies is that while there are plenty of good ones that would make an excellent investment, there are also a lot of state-owned companies that aren't solely about maximizing shareholder value. Very often SOEs have another objective, and that's to pursue policy aims of the state. And that doesn't necessarily go hand in hand with making money for shareholders. And so whereas a passive investor buys the market and simply allocates half of their portfolio to state-owned companies, an active investor has an opportunity to use data and perform analysis to try to pick out the good and the bad state-owned companies and make an allocation to the state-owned companies that have an advantage and should provide better than market returns going forward. And so once again, in terms of not only pursuing those mispricings, but also avoiding risk in emerging markets, we think that active investing is really the way to go. Now, the last question was, can we take the strategies that work around the world and simply apply those strategies in China and have success? And I've already shown some results that suggest you can take simple quant strategies and deploy those in China, and they'll produce better returns. But what I want to argue now in answer to that last question is that, like state ownership, there are a lot of features that make China's market different. This is something we see generally in emerging markets, because emerging markets, they're all starting from different places and they're trying to converge to developed market status, but each market's taking a different path. And so you'll find lots of differences, not only in terms of something like state ownership, but with respect to features like accounting standards and the way that companies pursue financial reporting, differences in the regulatory environment. That's something that's been really prominent for Chinese stocks in the last year, if you're reading the financial news. Differences in the way investors behave, differences in the way stocks trade in these markets. And all of these nuances create unique risks. They also create opportunities. They create new data sets that we can use to analyze stocks. And so Rayliant's approach is really tailored to the features that make China's market unique. We've got a research team, as I mentioned, on the ground in China because we think it's important if you're going to invest in this market, not only to avoid risk, but also to enhance performance, to do better than those simple quant strategies that I mentioned before. We think it's really critical to tailor strategies, to localize strategies to these unique features of China's market. And as I said, I think for the onshore market, where there's greater growth opportunity, better diversification benefits, and much more opportunity to pursue these mispricings and generate alpha, taking this tailored approach, we think is the best way to construct a China exposure. So I want to thank Equal Ocean for inviting me here. I'll suggest that if you want more information about the fund that I mentioned or about Rayliant's research, you can go to funds.rayliant.com, and please feel free to look me up on LinkedIn and connect with me there. Thanks, everybody. Have a great day.
All right. Good morning, good afternoon, and good evening, everyone who's joining the meeting online. This is Chen from Plug and Play. Thanks a lot for the invitation from Equal Ocean. It's an honor to be here to be able to share some of our insights and findings. So first of all, I'd like to spend a couple minutes introducing our company, Plug and Play. It's a Silicon Valley-based startup accelerator / early stage venture capital firm. The company started back in 1998 from Palo Alto. Our first office was located right outside of Stanford University, where we're fortunate enough to host great internet companies like Google, PayPal, Dropbox, and Logitech. And our founders, Mr. Rahim and Saeed Amidi, were early investors in some of these amazing companies. Fast forward to 2006, Plug and Play set up its current and the latest global headquarters office in Sunnyvale in California, the center of Silicon Valley. It's very close to the new Apple office as well as Google and Facebook. So since then, Plug and Play has been very actively investing in many early stage, meaning seed angel to anything between Series A startups on a continuous basis in the past around 20 years. But in the same time, the company also started the new business model, which is we call it corporate open innovation platform, which I will introduce a little bit more. So today I prepared around 25, 26 slides. So I'll try to speed up and try to wrap everything up in the next 18 to 20 minutes. As I mentioned earlier, since the establishment of Plug and Play in 1988, we have now been in operation in over 40 global locations and based in our Beijing office. In China, we have a team of around 120 staff, and our China offices cover Beijing, Shanghai, Shenzhen, and a few other cities in China. And also we have big operations in Europe as well as in America, including North and South America. So far we have around actually 1,000 startups in our portfolio. And in the meantime, we work with over 500 large Fortune 500 and China Fortune 500 corporations in creating or connecting the latest technology, the latest startups with traditional business and traditional industries. This is kind of a snapshot of what we do. And this research is done by our team, not just by myself. So I want to make that clear. So currently in China, we're living in the so-called startup economy. As you can see, the bottom of the chart is the large-sized business, meaning mostly the corporations. They could be the multinational corporates, the private, including the state-owned or central government-owned entities. And in the past 5 years, we've been working with around 100 large corporations in China, including the 4 types I mentioned just now. And our findings is that these corporations are more than before with interest and focus in gaining more connectivity, more competitiveness, and the driving force to drive from their traditional business into new business models, facing the new era, new consumers, new customers, with the help, with the support, or with collaboration with the startups, which you can see on the kind of top side, the small size business. And in the middle is actually the ecosystem and the platform, really, to connect and facilitate the connections and the partnership. And for a lot of startups in China, especially in the early stage venture capital world, it's very active, even though there's always been ups and downs. But still, there are so many top-notch talents, coming out of companies like Alibaba, Tencent, or coming back to China from Google, Facebook, Twitter, to found their own tech startups, which is the main focus for Plug and Play and our investment team. A lot of these companies are working in the robotics industry, in smart city, in new retail, in energy sustainability, which I will kind of divide and conquer in the following slides. So as you can see in this chart, a lot of and more large corporations are kind of targeting or customizing their products through the combination or joining forces with a lot of startups to face the customer, which is the top of this graph. I hope this graph kind of explains what we're trying to do now. And take a deeper look. Apologies for the chart. Mainly all the technology details are described in Chinese, but you can see on the top row, you can see the location-based services, map, over-the-air technology, NLP, natural language processing. All this type of public service technologies are based on data aggregation and equipment access. So for each layer of this ecosystem or the technology hierarchy, there are many very good startups, good entrepreneurs working and solving challenges and problems in their particular area. And instead of large corporations trying to put together a new team to kind of conquer the problem themselves, they should really be just leveraging on existing solutions and working with startups to enhance their overall capability in facing new technology challenges. And to summarize what I just described, is we've been working hard both in China and in the rest of the world to create this, we call it all-in-one solution. It's really a startup ecosystem, which is composed of venture capital firms. In China, on average, we invest between 30 to 40 startups per year. And globally, we invest in anywhere between 200 to 250 startups per year in the past 3 years on average, which is significantly more than what Plug and Play has been doing 5 years ago. And what we mentioned again, it's the corporate innovation part, which is a very important component for this ecosystem. But not only the industry, the market being the corporate and the money, right? The venture capital matters. The ecosystem is always asking for more resources for these entrepreneurs, including a lot of networking opportunities, a lot of mentorship opportunities, having advisors, mentors coming from research labs, from corporate executives, coming from serial entrepreneurs or venture capital firms, and not to mention a lot of foundational support, including the IT service, cloud service, office space, and a lot of connections, especially in China, which is very important to find the right way to collaborate with individual cities and government. Because in China, a lot of technology growth and technology, the new development directions is guided by government programs and policies. So we also put a lot of focus and attention in this area in China as well. So I prepared 6 cutting edge scenarios, including digital intelligence factory, health, and etc. And for each scenario, I won't have enough time to go into each individual technology, the bullet points. I hope you can read the slides yourself. But for each scenario, I prepared 2 video clips. Excuse me, using the either startups in our own investment portfolio or startups that went through our international or domestic startup accelerator programs to showcase what's the latest technology, what's the latest the most exciting entrepreneurs they're working on. So the first, a digital intelligence factory, because as many of you already knew, China is going into a revolutionary period where, the average cost for labor has been increasing, but still, manufacturing is still a big part of China economy. But more and more factories are now considering the manufacturer or the factory management system and using big data, using 5G technology, and even the digital twins and a lot of software, platforms as service, software as a service, to make the factory and the entire manufacturing processes more smarter and more intelligent. And these are some of the core corporates we work with, and through working with them, we kind of extracted some of the key focus areas, including agile manufacturing, smart logistics, quality inspection, and etc., into the areas that we look for in terms of sourcing startups, evaluating investment opportunities. And the 2 startups we prepared, one is one of our investment portfolios called Flexive, and the other one is the Black Lake, which went through our acceleration program. So to give a better and easier understanding, you can see what Flexive does. They actually came up with a very adaptive robotic arm solution. It's a total solution, including the hardware, the software, the computer vision tech, and these are some of the amazing things they can do, just completely automatically by their algorithms as well as their hardware. As you can see, it's a ball balancing play, which is completely controlled by the robotic arm and the program, and it's doing such better job than a human arm, as you can see in the later part of the video. And the amazing part is why the product is called adaptive is, it can actually it has sensors in each joint of the robotic arm, so it can adjust according to the pressure you put on the robotic arm. Yeah, I won't go into detail because time constraint. And the next scenario is actually related very closely to the carbon neutrality, and we call it real estate and construction tech. So we're looking into the space optimization, energy efficiency, and also through the sensor layer, communication layer, including 5G, ultra wide band, Bluetooth, and NFC, and you name it, the technology that from the design and construction providers and software, hardware providers and developers, they each are looking to specific areas and specific technology to enhance the overall cost and the cost efficiency and also labor safety, as well as how energy efficient it can be for both building a project to maintaining and for the property management team or the property management systems. And the example I prepared for you guys is another portfolio of plug and play. It's called Robotic Plus. It's a software company that's implementing computer vision and robotics technology to create digital twins, and also to leverage on the digital twin model to build real and to construct real projects in real buildings. As you can see, this is the digital twin parts, right? So it's in the real world. You can see the real objects being modified, being 3D printed, and also this technology can be used for inspection inspection work that's normally not suitable or is very dangerous for real worker to work on. So, and this is another portfolio called X Power. They came up with this very smart. We call it smart baseboard system. As you can see, or as most of your family or office has surrounding your household, surrounding conference rooms, you have the baseboard. In Chinese, we call it 踢脚线, baseboard to protect the wall. But instead of a traditional baseboard, they came up with this channel system, which actually allows this baseboard to be able to provide either 220 voltage or 110 voltage electricity whenever you plug the smart plug into the baseboard. So it's not only very easily used, and it is very safe, and also it worked very well with overall decoration and style of a lot of conference rooms and meeting rooms and kitchens, and you name it, many scenarios. So if you're interested in looking at these products, you can check them out. The next scenario is entertainment tech and metaverse. It's a very hot buzzword in the past year and a half. There were many companies and venture capital firms investing in AI avatar, AI creations, and also in conjunction with blockchain. You can see the non-fungible token, the decentralized financing, and all those technologies, and the target corporations, the corporations that are actively looking for this technologies are in the middle. The example I showed you, I'm going to show you, is another portfolio companies of plug and play. It's called Archifiction. What you're seeing in the screen is that this person, the founder, sitting in front of a totally projected content. So everything you see is projected by a device composed of projector, the lenses, as well as algorithms and cameras that can catch and capture your movement, and based on your movement and your gesture, can create very interactive naked eye. You don't have to wear any eyewear devices, to have this very interactive 3D environment, which you can have this entire facility set up in less than a day. Due to time constraint, I'll skip. I'll go over very quickly the last three scenarios. We have been working hard on low carbon transportation, which is part of our supply chain and logistics team's effort. A lot of logistics companies and supply chain companies like Maersk, Sinotron, DHL, SF Express, as well as GLP, JD Logistics, and a lot of our corporate partners in the mobility space. They're looking at the better management system, autonomous ship. And I want to show you this amazing investment that Plug and Play did around 2.5 years ago. They're now running a full L4 level autonomous driving fleet of over 200 robo-taxi in Shenzhen. So if you happen to be in Shenzhen, you can try to haul a AutoX robo-taxi to have a test. And the second to last is the smart cockpit. It kind of relies within the mobility space as well. I won't go into details, but since the adoption of new electric vehicles and a lot of smart vehicles and the V2X concept and technology, so there are a lot of amazing tech. Take this LED company, and that's part of our acceleration program, that they use a very smart LED tech for both inside interior, the cockpit, as well as the exterior lighting for cars. The last but not least is digital health. The telehealth. We have a lot of. I think the telehealth part is more widely adopted in the U.S. and other countries, but in China, we're seeing a very fast speed growth in this space, and we're also helping with a lot of smart hardware companies to come into China market. Take this last example is a Harvard team coming back to China, working on this optimized method to increase the support, both hip support and leg support for disabled people. Yeah, so that's my 20 minutes. If you by any chance are interested in seeing more, cutting edge technology and startups, or if your companies or your corporations are interested in connecting with some of our portfolio companies or accelerated startups, please feel free to reach out to us through bp@ppchina.com or reach out to me directly. Thank you.
Be important to watch during the next year. To give you a bit of context, SOSB, the fund that I'm partnered of, is right now the most active early stage investor in the world. And we make those investments not just in the US, where we are from, or China, where I'm based. We actually make these investments quite globally. As a fund, we have a very distributed presence with a very heavy activity in Asia. And we're proud to announce today that we just added another office to our network in Asia, recently opened in Bangladesh, Dhaka. As a fund, we're very diverse in terms of investing globally, and we cover multiple industries from fintech to travel, education, commerce, mobility, really almost every single industry is something that we invest, and as I mentioned, all over the world. So today I want to talk about these new trends that I think are going to be very important during the next year, and I'd like to organize them in 3 areas. First, I want to talk about geographic trends, something that we're seeing increasingly more and more activity. I want to talk about some of the shifts, some of the major macro changes that we think are defining the evolution of venture capital. And then finally, thinking of venture capital and not talking about technology is something that at least is weird. So I want to talk about some of the technologies that we think are going to be playing a very important role during the next quarter. So in terms of geography, probably the most interesting aspect that we're seeing is the evolution, the growth, and the relevancy that new markets for venture capital are having. Obviously, China and the US, major markets, are still going to continue playing a very important role, but we see areas like Middle East and Africa, where only this year we've seen a 3x increase in the level of activity in venture capital. Most of this activity is early stage. So as these companies mature and these companies create opportunities for new investors, we'll see more and more activity happening. Just today, during my few meetings that I have this morning, I met with 2 Chinese funds that were already exploring new investments in Africa, and our 8 portfolio companies that we invested during the last 6 months in the region. They're in constant conversations with funds from the US that are exploring investing in that territory. But probably the area that we've seen the most surprising growth has been Central and Eastern Europe. The ecosystem in Western Europe has seen magnificent change during this year. We've seen a massive growth in number of unicorns, and this is an area that is already relatively consolidated. But this 5x growth in this area is very interesting. It's very interesting because this has been one of the side effects of COVID. Central and Eastern Europe have very strong technology foundation. We have already seen companies like Skype that were founded in the region, and we've seen some other players very important in the area. So for these companies that today can benefit more than ever from the fact that we are all more used to virtual business, we see a very, very strong interest from investors, and we expect even more growth coming from that area. But probably the area that we're more bullish about, the area we're seeing the most growth right now, is Latin America. The overall growth in Latin America is higher than any of the other frontier markets that we've explained. There's a really interesting dynamic in that market where we see more consolidation, where we see more activity, and where we can already see the very strong presence of Chinese venture capital and Chinese large companies operating in markets like Brazil, but of course with a great influence from North America, where a lot of the leaders that are being the promoters of this growth of the ecosystem have some of their networks, their foundations, and where they were trained. Of course, we cannot talk about venture capital without mentioning India. India has been a market that consistently has been growing more and more, and now we're seeing dynamics in India that we saw in some of the golden years when the Chinese venture capital was taking off, and we started to see some of these growing pains of a market that is already stretching their growth and is expanding to bring in even more opportunities. In terms of my major shifts, one of the points that is becoming more and more relevant in the agenda is climate tech. Climate tech is becoming very, very, very important. It's today the agenda that is present in a lot of the boards. Is something that is becoming more and more relevant, and if it is becoming a major opportunity for investment. We, as SOSB, have been quite active in this area, now consolidated as the most active investor in that space. And what has been interesting is when we announced our top 100 climate tech companies, at the beginning of the year, we had a portfolio that was valued around $2 billion, and in less than half a year, we saw that portfolio grow from $2 billion to $6 billion. And this is something where we see a massive opportunity. We see a $5 trillion market opportunity. Recently, we organized Climate Tech Summit, where we have multiple personalities very, very, very active in this place. And we had the honor to host Bill Gates today, personally, one of the most active investors in the space, where he forecast that there would be more than 10 Teslas coming out of the climate technology space, and only one of them is well known today. So there's a massive opportunity for new companies to be grown there, to change the space, and to be able to create opportunities for venture capital investment. We see this space now consolidated, and it's going to be just growing during the next time. And this is only a subset of the whole ESG concept. This is becoming extremely more important for companies, not just because the boards are getting more aware of the importance of the environmental and the sustainability aspects of it, but because consumers are starting to develop. And we see some of these small companies that are able to create products, create solutions that they can test in markets like China, and they see those solutions that are solving the problems, the challenges that organizations have in this market, becoming global standard solutions for the rest of the world. That's one of the case of one of the portfolio companies, No Global, that help helps multinationals make sure that they can secure sustainability in the supply chain. And after testing the product in the mainland China market, exploring if this could be scaled in other markets like India and Bangladesh, in less than 6 months decided that that was a solution that they wanted to roll out globally. And this is something that we're seeing in more brands working with that particular company, but we're also seeing this dynamic coming and happening with more and more organizations on a monthly basis. Fintech is also an area that we've seen a massive growth during this year. The volume of investment in fintech has doubled globally in the last year, consolidating itself as already almost 1/4 of the total venture capital investment. And this is something that is quite interesting because we see this fintech becoming something extremely relevant. We're seeing it becoming as the blood of a lot of business models in the digital space. We're seeing today how this embedded finance, both in the more traditional financial services, but also in insurance and some other areas, becoming extremely critical as a new monetization model that is happening for a lot of companies as advertisement starts to become more and more competitive, and the regulatory space on data privacy is limiting the ability of these companies to be able to really extract more value of the users. And if we talk about technology, probably one of the areas where we see a major shift that we think is going to be very, very important is this battle that we're seeing, where all the large players, all the big internet, are competing against traditional players, and those traditional players are realizing that digital transformation, enabling real change, is not just about bells and whistles, is not just about having pretty interfaces, is not just about having new websites, really requires a change for within. We're seeing this as we work with today over 200 multinationals in different innovation challenges, and we're seeing the change in terms of how they look at opportunities for collaboration with startups, opportunities for collaboration to really enable the change. The way we see it is that this COVID-19 has been the major leader of this transformation, and this is something that has started. And as companies realize that this is a big change, they enable it and they see how more change can happen. And this is going to be a chain that will force more companies to adapt the change, and those that have already adapted the new solutions be able to create more and more push more and more competitors to have to adapt that. Basically, the way it looks like is something like this. You have the cameras where from the outside, they might look very similar. You can change the design, you can change the way things look like, but the real difference is inside. The real difference is in the core systems. Without a proper change in the core systems, nothing will be able to happen. And the key here, one of the things that we're seeing more interest is that it is not just about who you are, it's about what are you able to do. We're seeing companies like our portfolio Ignitica enabling very established players like AXA, where traditionally they will only trust some of their core systems to very established organizations. And today, this is something that they consider, well, what we need is change. What we need is result. What we need is specialized solutions. And the trust of that traditionally has governed this enterprise technology, where the thought was, if it works, don't change it, is no longer a fact because it is not working. So you have to change it. This is driving a massive change in traditional industries that are becoming more and more digital. An example where we're seeing massive movement is an industry as traditional as the construction technology. One of the industries that represents the largest GDP in the world, but an industry that is so inefficient internally that technology is basically changing and is bringing a lot of efficiency. Any company that doesn't adopt technology, does not play with the same tools that other competitors are playing, are going to be basically out of business. So this digitalization for traditional industries is going to be a major thing that we're going to see more and more during the next year. Something that is also quite interesting is how companies are realizing that this technology is not just about building new features, it's about enabling new business model. Something that a company like Xiaomi in mainland China has shown to not just this market, but the rest of the world, how this is something that beyond selling a product that may be better or worse than others, you can always drive more value to the users, and you can capture more value of the users if instead of just focusing on the product sale, you build a relationship with the user and you monetize that relationship with the user. We see companies like Samsung, still today the largest mobile phone manufacturer, mobile phone distributor in the world, working with companies like Travelfly, where they install the company so they can maintain that relationship with the customer, and they can monetize not only the sale of the mobile phone, but everything that the user are able to do in their mobile phone when they buy something, when they decide to make any transaction, and they're able to capture value from those users. And of course, not going to get too much in detail on this topic, but Web 3.0, metaverse. This is something that has been happening during this year, and with the latest movement, we see how this is becoming more and more relevant, and we're quite excited to see how the ecosystem will develop, probably quite parallel inside mainland China, where we see a lot of activity on digital assets, collectibles, and of course AR and VR activity all combined, and how is this going to evolve also in other parts of the world. Very excited to see what's going to happen. But probably one of the most interesting things that we want to see, and that probably we don't have an answer on what's going to happen, is how is going to be this post-COVID world. There has been a lot of businesses that they've been waiting for reactivation after things normalize. What's going to happen with travel? What's going to happen with more offline activities? What's going to happen with all of these online to offline businesses that we're creating a lot of opportunities? But potentially an even more painful trend that we all want to watch is what's going to happen with all the hype businesses. There's been a lot of businesses that have grown during the time of COVID, and we all waiting to know. I mean, are we going to go back to the previous stage, or is this becoming a new practice and everybody's going to continue working with things at the same time? Well, these are the initial thoughts that I wanted to share regarding the trends that we see as very relevant in terms of the geography, the major shifts of behavior that are driving the agenda of venture capital as the demand is driven, and some of the most accessible and simple technology trends that we think are going to set a lot of the activity next year. And now we're going to check if there are any questions from the audience, and we'll take it from there. So. Okay, we have questions here.
My name is Tsatse. I'm the investment director for Zimu Venture Capital. So I'll just say good evening from my side. It's almost 10 p.m. here in Shanghai, and I believe everybody's in a different time zone. So good day to you, good afternoon, maybe good morning to you too as well. So I'm, like I said, Talent. I'm the investment director for Zimu Venture Capital, which is based in Shanghai and Hong Kong. So we are early stage VC. We invest in early stage startups, mainly deep tech. But we've been stretching ourselves for the past 1.5 years, because of the COVID pandemic and everything. So yeah, we've been having the same as you, I'm sure. We are the same as everybody. It's been quite a year, 2020, 2021. But I think we are getting there. We are seeing some new trends. We're seeing some new trends. And I believe it's given everybody an opportunity to dig deeper. It's given an opportunity, especially to entrepreneurs and innovators, to really search out and discover the matter. And for us VCs, it's been quite challenging, I would say, really trying to get ourselves involved in all these new innovations that are coming up, new solutions that have been coming up. It's really hard to, accept something new as a VC, of course we see that it's there, but the rapidness that has been caused by the pandemic, when we have all these new innovations, it's something that makes you pause and think, oh my God, am I going in the right direction? Should I get in or not? And there's always the question, which one of these startups could be the next unicorn? Which one could be the next decagon? So I'm happy today to be here sharing with you all. And I'm happy to meet new friends and old friends. I had quite some interesting time in the networking session, met quite some old friends and also some new friends. And I also really want to say thank you to Equal Ocean for this opportunity, for putting this together, for bringing everybody together. It's an honor for me to be here. It's I'm really grateful that I'm here. And as I dig deep into it, I hope I not just share my thoughts, my insights, or what we and my team at Zimo believe in, or the direction that we're headed. But I hope to also get some feedback. I hope to, make it a two-way thing whereby you guys, the audience, can also pitch in, have some questions or some contributions to it. I'll begin by talking about how the pandemic has generally affected, especially China. I've been based here in China for 10 years. I've been doing this for the last 10 years. And from what I've seen, the COVID-19 pandemic has brought about quite enormous shaking, enormous changes, and great challenges for those who accept them. So as you all know, China has been very good at managing and handling the COVID-19 pandemic. It's been extraordinary what they have managed to accomplish, how they've managed to put an end to everything, how they have managed to contact trace, how they've managed to do the management and to maintain an almost zero COVID policy. Though we have a few cases here and there, but they do not disturb the way of life that much anymore. But because of that now, it's like the borders have been closed, and China still hasn't quite opened its borders yet. And this has brought about a new trend in the China space itself, in the ecosystem, business ecosystem. We're seeing that more and more VCs here, local VCs in China, are beginning to stretch out more of their funds into local projects, especially import substitution. That has been caused by not just the pandemic, but also the supply chain disruption that is going on globally. So what's been happening there is that a lot of VCs are seeing opportunities to incorporate import substitution on the Chinese market, and they're betting a lot into a lot of import substitution. And on top of that, because of closed borders, it's also created an atmosphere whereby local innovators and local companies and startups are able to begin competing with their peers all over the world. So for Chinese VCs, there's a lot going on locally here. And I think it's also an opportunity for international investors to invest in a market that has been able to deal with the pandemic once and for all, and that plans to maintain the same policy to manage the pandemic. It's a big opportunity for outside investors as well to invest in some of these projects that are going on, import substitution and innovation. The tech industry is booming. You might all know that this year, over $175 billion went into Chinese startups. So this is a trend that I've been noticing here in China. And then from what I saw on many other insightful reads that I managed to get my hands on, is that we are now getting into almost the same peak level that was reached in 2017 in terms of investments in China. So with a few weeks left before the year is over, I think that target is going to be hit and done with. So I believe that the biggest driver, the biggest stimulator is the handling of the COVID-19 pandemic. And local players understanding that we cannot just keep on relying on outside technologies, but we can actually begin to make our own innovations here. And the VCs have been able to accept that, and they have welcomed it, and they have seen the opportunity, and a lot of them have actually bet a lot on it. And then as we also see closer to home around China, China has been very active. Chinese VCs have been very, very active in the Asia Pacific. There've been a lot of massive deals that have happened since 2019, especially in India, where you can notice that as of end of 2020, at least 17 out of the 24 unicorns that were created, 17 of them were backed by Chinese investment. So that is a trend that we were seeing. It started around 2018, 2019. It really got to peak, but with the pandemic, it's kind of like flattening out. So we're yet to see in 2022, as we get into 2022, how that is going to play out. But I think with VC, it's always about the outcome. It's not really about the terminology or what is happening. The environment, of course, plays a major fact, but it's always about the outcome. So as we are so uncertain with the pandemic, there's still a lot of outcomes that need to be determined. Yes, we are seeing a lot of new solutions that deal with the current environment that we're in, but it still makes an investor. There's always the question about the outcomes. Now it's no longer about what you're proposing. It's not about what you're proposing, but it's the solution. Yes, I like the solution. The solution is good, and as investors, we see a lot of solutions that are good. We see a lot of solutions that can potentially address the situation that we are in, but then it's still it's now getting into a phase of okay, so tell me the outcome, tell me the results that I'm expected to see. So with that, I want to dig deeper more into the healthcare. The healthcare is one trend that I'm really betting myself. I'm betting myself personally and my team. And a lot of friends that I've spoken to, even tonight, as I was talking to some friends, there was a lot of discussion about digital therapeutics and healthcare in general. With the pandemic now, there's a lot of anxiety, not just from people themselves, but from companies as well, because as companies now begin to let their workers work remotely, let employees work remotely, there's a greater need now that to ensure that their employees have a certain standard of health, which can be provided digitally, as is the new trend. So there's a lot of investments going on in that area, and it seems like I was saying, it's no longer about what the provider brings, what the startup brings. It's about now we want to know the navigations. We want to know more about the outcomes. We want to know how this software or how this solution that you're proposing, whether you're the payer, the employer, you want to know, okay, if I pay this for my employees, I want to know one thing. How is this going to engage them? How is it going to intervene in their behavioral change? What can we expect? Are we expecting to see blood pressures being monitored? Are we expecting to see BMIs being put to check? Are we expecting to see people losing weight? Are we expecting to people to get a better mental state? So it's not just the integration that I'm looking at for now. Yes, prior to this, perhaps 8 months ago, I'll be very curious to know the integration. So, okay, your system allows my employees to dial directly to the doctor right online, have a conference with the doctor, have a discussion and probably a prescription. But now I want to know how is this going to engage? Because of course, yes, you want a subscription to be paid, which of course many employers are willing to do. But with VCs, it's more like, okay, so besides the subscription, because everybody might end up doing this. Everyone might end up offering this subscription. Even small hospitals themselves might end up saying, okay, we are going online, and all you need to do is pay your subscription. You have a problem, you call us. So now we want to see the engagement. We want to see the sense of well-being that comes out of using this certain software. But this is a mega trend that I predict will be there for the next maybe 5 years. Intelligent Insights predicts that digital therapeutics will be at an estimated value of industry estimated to be about $56 billion by 2025. And so it's something that a lot of us are betting on. We're hoping to engage with a lot of various startups who are in the space, newer startups, and get an insight of what it is that we could be getting into. What is the trend? What exactly are we entering? We have already entered the digital therapeutic stage, but now we want to know what more can be done. How can it be improved? Where is it going to be the peak of improvement, whereby it's an all solution provider? Yes, there are already some all solution providers, but I believe that there's quite still a long way to go. And then as we go on, as I wind up, earlier I was also talking to a friend during the networking session, and I was talking more. I was leaning on artificial intelligence, and he said something very interesting to me. He said, you know what, artificial intelligence is not a trend anymore. It's already there. It's something that is absolutely there. And it got me thinking for a few minutes. And I said, yes, absolutely. I believe you're right, because as we've been seeing it, it's China right now holds about at least 40% of all registered patents in artificial intelligence. And Japan and the US, they probably share about 30%. I think US is about 12%. I'm not quite sure about that, but China holds at least more than 40% of the patents. So I've been leaning towards this and betting that, okay, if China has all these patents, that there is a lot of room for collaboration with outside players, with outside startups, or even bigger companies. By holding these patents, it puts a lot of Chinese startups at a good position to engage in international partnerships that could help them. So this is something that is worth an investor's eye. It is something that investors need to dig deeper into. And then after he said to me this, that, you know, it's already there. It's not a lie. It's a fact that China is doing really well in artificial intelligence. They're able to put in a lot of data. They're able to correlate a lot of things in a very short time compared to the rest of the world. So they're leading, but is there still an opportunity for VCs? That's the question. And then it came to mind that what about world digitization? I think for me, I would say that digitalization is a secret weapon to a lot of acceleration. It's a secret weapon to a lot of development that we are about to witness. And, you know, I think we're going to see it at a more personal level. Like consumers, every consumer is going to be able to appreciate the use of the world digitalization. Everyone is going to be able to appreciate it. And artificial intelligence combined with this, with the chips, with the telecommunications, with everything that's linked together, whereby we're going to see actually devices communicating with each other. We're going to see devices asking for resources. We're going to see devices allocating resources. We're going to see a fully digital world whereby everything works on its own. We're going to see the manufacturing sector all over the world incorporating being digital and being, you know, the machines are going to be able to source their own raw materials. The raw materials where it's going to be sourced is going to be a device that's going to negotiate a price, that's going to arrange the logistics to send all this. So I'm just thinking as an investor, the opportunities that lie in this. Have they all been taken away? Have they all been filled up? Is there still space for VCs to get into digitalization? Or is it something that's already been taken by big players? Is it something that the big tech, Tencent, Baidu, Amazon, Apple, have they filled it up, or is there still an opportunity for younger players? So I'm just thinking that we are going to witness an immersed trend, something very different, something very unique. So I just want to encourage all other investors to, you know, keep your eyes open, keep an open mind. There's a lot of evolution that's about to take place when it comes to digitalization of everything. There's got to be something more. I believe there's still an opportunity for everybody. I think it's a new dawn. It's a new stage. It's like a new beginning for those who have been left out behind. So as we move forward, I hope that we all keep our eyes open. We all see the opportunities. I believe there's always more. You know, I have a saying that there is always more. So I think the best in the terms of digitalization is yet to come. The best is yet to come. And I'll be here in China, and I'll be looking forward to a lot of collaborations. I hope to have a good seat in the front as we move into digitalization. And I hope to meet new friends and old friends. And finally, I'd just like to say thank you. I wish I had more time to share. Actually, I didn't even deeper into my presentation, but I hope there's more opportunities and more time to discuss and speak. And I hope you're well wherever you are. Stay safe, and the best is yet to come. Goodbye. Thanks.
Hello and welcome. My name is Rahul Shah. I'm head of financials research at Tellimer, which is an emerging markets research and technology platform. I hope you're enjoying the conference so far, and I'd like to thank Equal Ocean for inviting me to speak at this wonderful event, and thank you for joining the session. Just a very quick introduction to Tellimer, as I think you might find our offering interesting. We're basically a one-stop research shop for emerging market investors, for both data and analytics. We have over 60 firms contributing content, including Equal Ocean. Those firms have around 500 analysts writing on 170 markets across a wide range of asset classes. If you'd like to find out more, please go to tellimer.com. Just some quick background on me. I've been at Tellimer for around 4.5 years, but I've actually been a research analyst for around 25 years, and more than half of that time looking at emerging markets. My sort of sector focus is financials, which these days means a lot of work on the fintech space. Okay, so in terms of what I plan to discuss today, time is short, so basically just 3 topics. Firstly, why I think global investors will keep increasing their weight to China over the long term. Second, a quick recap of what's gone wrong this year. And third, some thoughts on how to best position portfolios going forward. After that, I'd be happy to take any questions you might have. Please do send them in as we go along. But unfortunately, for compliance reasons, I won't be able to speak in detail on any specific individual companies or investments. Okay, so why do global investors need exposure to China? Well, obviously it's the second largest economy, so that's a key reason. But also, despite global investors raising their weightings to China, their weightings haven't really kept pace with the reality of the economy. So, you know, over the last 5 years, for example, the weighting in the EM emerging market benchmark index has almost doubled. But if you look at the equity market cap to GDP ratio of China, it's much lower than developed markets. You know, it's around half that of the US, and it's even lower than India's. So I think there's a lot of headroom for the equity market from a structural perspective, and global investors will continue to be very interested in what the Chinese economy has to offer. The other point that I think is important to make is that China is now an extremely sophisticated economy. It's no longer just a low-cost producer. It's actually a high-quality producer. And to illustrate that point, I'm using some data from Harvard University's Growth Lab. It's the Atlas of Economic Complexity that they put together. And this looks at, in some detail at around 1,200 products, which they rank by complexity, and they look at the export and import flows of those products. It mainly covers goods rather than services, but I still think it gives you a useful benchmark of where each economy is. And just to give you a sense of why I think this is relevant, if you look at the top 3 countries in this index, they're basically Germany, Japan, and Switzerland. So economies that have a reputation for high quality and whose citizens have high quality of living. So how has China done on this basis? Well, over the last 20 years, the ranking for China has gone from 39 to 16. So it's within touching distance of the US, for example, which is ranked 11th. And to put that improvement of 23 places into context, less than 10% of the 130 or so countries in this survey have increased their places by 20 places or more, and China is the highest ranked of those. So China clearly has done a lot of things right in the past. But I'm also confident that that ranking is going to keep increasing. And I say this because when we look at the 20 products that the Atlas says are the most complex, China is already a top 5 player. And that's the chart on the right, where, again, I've compared China and the US. China is already a top 5 player on average in those top 20 products. And it has a 13% share on average of global exports. So basically, it ties with the US in terms of these products. So what is holding China back in terms of this ranking is not that China doesn't have the expertise or the infrastructure. It's simply that China also has quite a big weighting in lower tech areas such as textiles, stoneware, and basic chemicals. And I think as China transitions away from those areas, the ranking would naturally increase. And we've seen that happening already. Textile market share for China peaked in 2015. If you look at stone products, China's market share peaked in 2014. So I'm confident that China's sophistication is going to keep improving, and that's incredibly important from an investment perspective, because if you look at global equity markets over the last 10 years, the investments that have done particularly well are, the high-tech areas, the tech-led disrupting companies. And within the emerging markets universe, the listed emerging markets universe, China has a much larger share of such companies than its average weighting in the index. So, by way of an example, we launched our Emerging Markets FinTech 50 Index earlier this year, and China has a 40% weighting in that. But we could easily have had 2/3 or even 3/4 of our constituents coming from China, because the ecosystem is so rich in China, and that experience, I'm sure, would play out in many other areas of high margin, high growth sectors. So that's the long-term backdrop, which I think is positive. But obviously, let's not beat around the bush. 2021 has not been a great year for investors in China. Absolute performance perhaps hasn't been disastrous, but certainly relative to what's been happening in other markets, China has massively underperformed. I think the main driver of that obviously has been policy uncertainty. There have been a raft of new measures being announced across a wide range of sectors. That has, I guess, made it more difficult for investors to project the future, and that uncertainty is reflected in lower valuations. If we look at ADRs, the experience has actually been disastrous. I think on average, an ADR investor's lost more than half their investment since the peak in February. And that reflects more geopolitical risk rather than policy uncertainty, I'd say. And that's basically that the US and China continue to size each other up. And unfortunately, these ADRs have been caught in the crossfire. So I think DD announced last week that they are going to try and delist from New York, and I think other ADR other ADR companies will follow suit, sadly. So in the short term, that process will cause quite a bit of disruption, and we're seeing that now. But China is just simply too big an economy. It's got a lot of attractive features. So I think if investors can't buy ADRs, they're going to buy local shares. And so the overall exposure to China will continue to grow, but we're just in this period of dislocation at the moment where we're shifting from global investors predominantly looking at ADRs to them having to look at local listings. Okay, so to recap, in my view, the long-term trajectory is clear. There are very strong arguments for investing in China and actually putting a greater proportion of your portfolio into China. The equity markets can grow faster than the overall Chinese economy if we look at global benchmarks, and China is active in many high-margin, high-growth areas where there's basically going to be greater returns from an investment perspective. But we are going to see more direct investment rather than ADRs. So that's basically the framework. I guess investors typically struggle to take a long-term view, but hopefully, unlike these two birds, your investment horizon extends further than Christmas. And if that's the case, how should you be positioned? So I'd highlight two broad strategies. The first is, unfortunately, I think the ADR investment case will remain difficult. Tensions between China and US are likely to remain fraught for some time, as both these global powers pursue their own agendas, and the common ground perhaps is going to shrink. So the chart on the left actually updates a study we did earlier in the year, which was basically highlighting that in certain key or exciting areas such as fintech, e-commerce, electric vehicles, or internet and social media, there are actually local listed alternatives that you can buy into, and there are also EM alternatives that are also potential alternative investments to ADRs. And you can see in general that both those categories of alternative investments have tended to outperform ADRs this year. So, even if the ADR universe is not attractive, you can still capture a lot of the exciting growth trends in other ways. And sort of allied to that, I think it's worth investing in key structural trends that are going to shape the Chinese economy over the next decade. I've highlighted four, but there are many others as well, I think. But technology leadership, military spending, domestic consumption, and aging demographics are the ones that I've selected here. And let's look at each of those in a bit more detail. So technology leadership, I think is incredibly important from an investor perspective. China is already an incredibly sophisticated economy. We've written in the past that from a blockchain perspective, for example, China is leading the world. The same in key areas of renewable energy, such as solar panels. Messaging and social media, again, the best Chinese companies can hold their heads up high in a global context. And China is likely to keep growing its market share in key strategic areas such as semiconductors. So I think there's a lot of areas for investors to get excited about from a technology perspective. And we've already seen that tech over the last decade has really increased its weighting in global equity portfolios, but I think in emerging markets that trend has yet to play out fully. In terms of military spending, I think China is going to keep increasing its spending in this area to defend its interests globally. But that will generate a lot of commercial spin-offs that private sector investors can tap into. Aerospace, space exploration. We're seeing that these are areas that investors are now willing to value. Electric vehicles, be it on the ground or in the shape of drones. Again, China has quite an enviable position in this space, and that leadership is likely to grow with the backing of this military spending. And high performance materials that can withstand extremes of the environment, whether it's temperature, chemical environments, electrical disturbances, etc. I think these are some of the areas where the commercial spin-offs will be particularly valuable for investors. Turning to domestic consumption, I mean, it's already been a trend for several years of a shift of focus away from an investment-led to more of a balanced or consumption-led economy. And I think that shift is going to build pace. And one of the key drivers of that is clearly the wish for the rewards of economic growth to be spread more widely across the Chinese economy. So I think that's going to open up a lot of opportunities for investors. One of the key ones that we've written on in the past is digital payments. So, the likes of WeChat Pay, Alipay, that they are the largest digital payments platforms in the world by a large margin. They process much higher volumes than global benchmarks like Visa or MasterCard. And despite that, China is still the world's largest financial inclusion opportunity. There are over 200 million Chinese adults who don't have the full access to the full suite of financial products. And I think digital finance is going to help those individuals access the full suite of products over time. So I think that's one key area. But there are a lot of other disruptive areas where China has a strong position, e-commerce, ride-hailing, deliveries, there are many others. So I think that's also going to be an interesting area for investment. And then the final point here is aging demographics. So obviously we've not had the one-child policy for a long time, but we're still going to see a steady growing of the population. That's going to bring a lot of investment opportunities to the table, whether it's through telehealth, remote monitoring, through medical devices. A lot of data is generated by these sort of devices, and by applying big data, artificial intelligence to those areas, Chinese firms will be able to generate low-cost diagnostic data that perhaps they can then export globally. We're also going to see, I think, a lot more tailored treatments, and I think the regulatory framework in China is perhaps more helpful than in other countries for development in these areas. And so whether it's drug delivery, diet, lifestyle changes, tailored solutions are going to be much more important as a way forward. And then coming back to sort of digital finance angle, digital insurance, whether it's for healthcare or life insurance, is also a key growth area. So at Tellimer, we've written on a lot of these themes from a global perspective. Our friends at Equal Ocean have also written on these themes from a more domestic perspective. But hopefully, over the last sort of 10 minutes or so, I've given you a few things to think about. And now I'm happy to go to Q&A. So let me just stop sharing the screen, and then we can go to some questions. Okay. So I'm just looking to see if there's any questions. I don't see any. I'll give it another 30 seconds in case they're coming through. Okay. So why do I believe that ADRs will be delisted? So basically, it stems from the pressure from both US and Chinese regulators against these firms. If we take the example of Didi, China is very concerned that data that it generates could find its way outside of China, implicitly to the US. And at the same time, the US regulators are demanding that any US listing should that they can have access to certain data, including, for example, auditor records and things like that, that China has indicated it's not willing to release. So from in terms of the regulatory framework of both countries today, it's actually an untenable position that ADR companies find themselves in. So that's why I think unless one side or the other provides concessions, I think there will be a delisting process. But as a longer term trend, I think because China is such an important part of the global investment story, investors will increasingly be comfortable buying directly into local listings. So the need for ADRs may also be diminished over the long term. Okay, so do you think NFTs would be able to exist in China under regulation? Well, I guess I'll turn to the concept. I mean, you know, I'll use blockchain as an example. If you think of pure blockchain, it's an anonymous network where no single party has control over what goes on, and that's, I'd say, anathema to sort of the Chinese regulatory framework. But China, nevertheless, has built a leadership position in this area by tweaking that pure blockchain model so that the regulators can have access to information. So I think, you know, with that example in mind, I think there's nothing in principle to stop NFTs from taking off in a big way in China, but maybe the classical model will also need some tweaks. I think we're out of time, but I'll just quickly answer the last question, which is, will more US stocks move to Hong Kong? I think yes, that's basically as an interim step. I think Hong Kong will be the big winner from these Chinese and US tensions in relation to ADRs. But maybe in long term, it would be the mainland exchanges that also attract investor interest. Okay, I think I'm out of time, but thank you very much for your interest and for your questions. Let's say if you want anything more, I'll be joining some of the chat rooms later, and also you can check out Tellimer.com. Thank you so much. Have a good evening.